It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world. My name is Patrick L. Young. The IPO-VID live stream, Series 18, Episode 3 on your 6 times table. That works out as Episode 105 starts here. Let's go straight to Asia, to the SAR of China, Hong Kong. Absolutely the best product news of the week, actually the month, the year. I suspect it's probably the best product news of the decade. It's all encapsulated in Hong Kong Exchange's Connect. 2 words with one huge yield curve trade in RMB starting from May the 15th. That's going to be absolutely spectacular. Elsewhere in the world of spectacular things and exchanges, well, Binance has become to some a euphemism for head shaking and oh dear kinds of exclamations. The latest news, Israel seized 190 ISIS-related accounts and the US is investigating Russian sanctions violations. How long has Binance got, ladies and gentlemen? You can read more about that every day, of course, in Exchange Invest, the newsletter of the Bourse Business, the exchange of information, or indeed, if you're just interested in particularly crypto and digital asset market structure, pop by Substack and look out for Bit Carnage. Great results this week from ICE with a fascinating insight, which is great news for investors who still haven't cottoned on to the fact that the world's best .com technology stock that is being priced at much lower multiples, the Intercontinental Exchange itself. ICE Mortgage Technology is somewhat counter-cyclical in initial client onboarding. That's even better for an exchange core tech business. And finally, there's a new exchange on the block, Artex. It's not just King Charles III's coronation commissions. Rule Britannia. I've got the cufflinks to prove it today. God save the king. Artex are going to be launching their first art IPO at a museum which bears, of course, its title to a previous monarch, Victoria and Albert. Cool museum, crazy idea. It's going to be interesting to see how this whole new world of art IPOs work, and that's happening from May the 30th. Our guest today is Philip Roscoe. He's going to discuss the topic of how to build a stock exchange. It's not going to be directly the nuts and bolts of building stock exchange per se, step by step. Although if you want to know about that, ladies and gentlemen, ping me a DM because, of course, that's our business. We build marketplaces the world over. Rather, we're going to have a fascinating, well, socioeconomic interaction, I suppose is one way we could describe it. Philip Roscoe is reader in management at the University of St Andrews. His research takes a sociological approach to markets and finance across diverse topics such as online dating, Santa's Lapland hideaway, from which presumably he also commits online dating, and many other topics. He's a former journalist. He was one of the first of BBC Radio 3's New Generation Thinkers, and his new book, How to Build a Stock Exchange, mingles history, technical detail, and humorous anecdotes to explore the nature and purpose of finance. Philip, welcome to IPO-VID. Where in the world are you today?
Thank you, Patrick. What a pleasure to be here. I am on the east coast of Scotland in St Andrews. For people who don't know, the university is 600 years old, established by Paper Bull, and it's a glorious, sunny, early summer evening in Scotland today. So very, very pleasant to be here.
Magnificent altogether. So tell us a little bit then about your career. Sounds like a rather polyglot existence. How did you get into journalism and how did you get further into academia and finance?
Well, so funnily enough, I did a degree many years ago in theology and religious studies. And when I came out at the end of it, I didn't quite know what to do. And I sort of kicked around. This was .com London in the late 1990s. And I ended up getting a job after some sort of various stops and starts as a journalist writing for a new magazine called Shares Magazine, which was set up in the height of the .com bubble to be a sort of slightly more, kind of everyday stocks and shares investment magazine. And then I worked for them for a while. I worked in a couple of other places, and I was really interested in why private investors funded, the kind of little businesses that we were seeing being launched during the dot-com era. And because I realized that, I never actually should have ventured out of the university into the real world, and I should get back quite soon, I went and I did my PhD on exactly that topic. I started researching private investors and their decisions. And I became interested in these sociological perspectives on finance, and really that's what I've done ever since. So that was in the 2003, 2004. I think I started my PhD, and I've been doing this kind of thing ever since, with a few diversions, as you say, to Santa's hideaway. My colleague was an elf. She was, Santa. If you go, you can fly to Lapland, and you get a sort of sled across the snow, and you go and see Santa in his grotto, and it's all torchlit and magical, and the whole thing is kept running by people working in elf suits, mostly students, as far as I can tell, with iPads. And my colleague was one of these, so we had an elfnography, which we were very pleased about. Boom, boom.
Well, there you go. The whole topic of elf and safety, presumably also being a major issue these days. Yes,
all of that. We wore
all of the terrible quips. Yes, I'm reminded of some years ago when I was somewhere in the midst of those amazing tunnels below Canary Wharf, a great tribute to the great Thatcherite boom of the 1980s, which we'll get on to in a moment. And I was having my shoes shined, and this chap looks at me very straight and said, my career isn't actually as a shoe shine guy. In fact, I'm really a professional Santa Claus. But, that's kind of seasonal work. At which I looked at him and went, oh, really? And then suddenly gripped the chair and looked around for where the hidden camera had to be, which I don't think it was in that case, but it certainly seemed like my candid camera moment, because it's like, yeah, Santa, seasonal work. Who would have guessed it, ladies and gentlemen? And there you thought all of those people being unemployed in the January unemployment numbers are all those builders who are frozen out of the Midwest or somewhere because of the ice and snow. Anyway, so tell me, I'm actually quite curious. What was the job description of the job you applied for at the august and incredibly historic St Andrews University?
I joined as a lecturer in management back in 2009. And I then was promoted after a while to a reader in management. I've been there ever since. So, but in the UK business school, it's a fairly Catholic kind of institution where you can bring in lots of different research perspectives and so forth, so long as you're broadly interested in the domain of management or organizational finance or what have you. We have lots and lots of different interests and colleagues. So it just, career-wise, after goofing around a bit in my 20s, I've had a very, very boring academic career where I've just worked here, and I've stayed here, and I've read and written interesting things, I hope.
Well, that's quite fascinating altogether. And let me just break off to say good evening to Peter Secon. Hello, Peter. I hope you and Ari and all the family had a wonderful long weekend for the coronation. Certainly seemed to be a spectacular occasion of pomp and circumstance that I could see on the TV. Delightful to see you. Thank you very much for joining us today. So Philip, you've written a number of different books in the past and articles and features. This latest one, it has this very catchy title, which obviously attracted my eye. What inspired you?
Well, it's a bit mischievous, really, Patrick. It's a how-to book that doesn't tell you how to. In the end, it's a question that I think is kind of unanswerable. And I picked up the title, and it sort of stuck. When I was working as a journalist in the late 1990s, I became aware of these two. I worked constantly in their orbit. These two smaller company markets in London. One still is called AIM. It's the junior market of the London Stock Exchange, and the other one was called OFX, and then subsequently became Plus, and now I think it's called ISDX. And they both were started in 1995. I sort of took them for granted really while I was working there, because it was just interesting. We saw the companies come and go, and they were both of them home for lots of interesting kind of IPOs, and it was all dot-com craziness. All of these new wonderful things. There was There was a firm called printpotato.com that was going to revolutionize T-shirt printing on the internet, and everything was on the internet. If you remember 1998, 99, you kind of plugged your computer into the phone socket, and it beeped and wheezed, and you went on the web, and you could kind of browse things. But everyone could see this amazing wide open future ahead, and everyone was trying to get a little bit of that sort of magic. So we had, there was a website, balls.com, that was the one-stop shop for anything ball related and stuff like that. And these firms, they were raising quite substantial chunks of money from investors and launching products and building infrastructure and so forth. And that, as I said, was what powered my initial PhD, with why would people invest in them. But then further down the line, I became interested in the markets and the story of the markets, and I realized as well that some of the people who were responsible for launching those institutions were getting old, and one or two of them unfortunately have subsequently passed away. So I actually went off and I spent a lot of time interviewing people and extracting the story of those two markets, the formation of those two markets, and that really is the kind of engine of the book, if you like, and the rest of it is a synthesis of scholarly work around the sociology markets, and also some kind of anecdotal recollections from my own career. It wasn't even a career. These few very early, rather naive, formative years in the markets themselves, the kind of things that I remembered. And so I think there are some quite interesting characters that circulate and some quite humorous moments. I think the whole thing kind of wraps up rather nicely today, though I don't say it myself, obviously.
Well, I must say, I think it's a great read. I find it very, very appealing. It's very readable. It reminded me, although it's a different book, but it's somewhat similar in many respects to a guest we had just the other week, Bob Pisani of CNBC. He had Shut Up and Keep Talking is his latest book. And I thought it was similar. I mean, it's that sort of social memoir about what went on, which actually was a very, very successful breed of finance book all the way through history, and particularly in the 20s, 30s, and through the 50s. There's some absolutely epic tomes on that scale. And yeah, so it's interesting. You're talking about the birth of AIM, the birth of OFX, which went all the way through, and it's now actually Aquis Stock Exchange, having been sold from ISDX under Next ownership, ICAP, formerly ICAP, to the Aquis Group just a couple of years ago. And yeah, I mean, it's a very, very interesting and thriving place. I hear you when you're talking about the dot-com bubble, because certainly when, I started my dot-com career in 1994, so we're heading towards our 30th anniversary of that next year. That's quite epic. Could have even been online doing business in 1993. I'm not sure, because I've never opened that pile of floppy disks to try and go through them all. Someday, I suppose, when there's a sufficiently long winter's night, we might get there. So tell me, I mean, the nexus of the book, you start by jumping back and across the Atlantic, and you go to Chicago. What's the relevance there?
So it's just a very interesting example of how the material and the technological and the historical combine to shape markets. So this is in a sense, the central argument of the book is you can't kind of just build a stock. I mean, I know you do all the time, but there are so many kind of external factors coming together that allow a market like the Chicago Board of Trade, which is clearly today one of our most significant derivatives markets, allow a market like that to get established and to flourish. So you have the industrial nature of the city, the stockyards, the agriculture. You have the city's location at the middle of this transportation hub, and the railroads and the telegraph lines that were then laid around alongside the railroad. So Chicago becomes not only a transportation but also a telecommunication sort of nexus. If you imagine a wheel with spokes spreading out across Midwest and across America, and you have a problem, and the problem is that agricultural products are heavy and they go off. And you don't want to be shipping grain from Kansas to Chicago to back again to sell it to the bloke down the road. So from all of that emerges a trading infrastructure that then demands a particular kind of regulation and particular sort of rules and weights and measures. So you can trade in things called to-arrive contracts, and these to-arrive contracts, they never have to arrive. That's the beauty of them. You can set off one against the other. So they then become these kind of early futures contracts, and then the market spreads along the telegraph lines. You have the ticker tape and so forth. And gradually, from this confluence of all of these kind of factors, we get something that looks like a full-blown modern futures market. And then it gets regulatory approval further down the line and all of these kind of things. So I think it's a very nice illustration. It's been well researched by a number of scholars, and it shows how the very kind of shape of the market, the sort of things that we take for granted, like the fact that one can do charting. If you're going to do charting, you have to have direction and velocity, and that depends upon the ticker tape. The ticker tape gives time to the market. It regularizes time in such a way that you can think of stock prices moving in the way that you couldn't previously do. So there's some very, very fascinating historical insights that we can glean from that, and that's why I started with that particular story.
It's incredible as well when you look at the whole history of Chicago. I mean, it was only what, founded as a city or a town in 1833, founded as a city in 1837, founds the Chicago Board of Trade in 1848, which is also the last year that there was a food blight on the mainland of continental Europe. I mean, essentially the area to main Central Europe, Central Eastern Europe. And it's also the year when the telegraph arrives in Chicago, which I'm sure is not altogether unrelated. And you're absolutely right. I mean, the ingredients you require to build a market are a lot more than what a lot of people foolishly think, which is any old rule book and some technology, and then you're all right. I mean, the whole art of building is a bit like nuancing restaurants. I mean, it's a lot more than just having a kitchen and buying a load of chicken. So the creation of those markets, that's very much a modern market enterprise. And then you bring us through the course of that history and how that starts to relate to London. Tell us a little bit, I mean, how did London then kind of catch up to these newfangled innovations, or was London actually involved at the same time?
Well, there's a sort of transatlantic genealogy right the way through. So London's much older. London's exchange dates from 1697, I think, is the first. Somebody called John Carstairs started publishing a list of prices, and that's kind of taken to be the beginning of the London Stock Exchange. And the London Stock Exchange shows the other thing that is really vital in the founding of a successful stock exchange is the interplay between the nation state and the exchange itself. This is one of the arguments in the book, is that the markets are kind of entangled with modernity. So what was happening during that period in London is we just had a new king. It was very appropriately. We had King William, who'd arrived from Holland, and he brought in lots of legal regulatory innovations from the Dutch merchants that allowed you to deal in stock in the way that deal in debt and other such things in the way that you couldn't previously do. But we were also having a war with France, and this meant that if you were a merchant in London, that you couldn't get your boats across, you couldn't get your goods across the channel. So the merchants were sitting with their hands idle and their pockets full. The merchants were called jobbers, people who bought and sell stuff. And the government, who was having this war, didn't have any money. And because we just got rid of our sort of despotic, old-fashioned kind of king who raised taxes and arbitrarily to fight wars, we now had a sort of democratic parliament with a king that respected that. The government had to find another way of getting money to fight its wars, but it couldn't borrow because we couldn't borrow from individuals in the way that governments do now, because the government debt was very illiquid. So what it did was it borrowed large sums of money from these new joint stock corporations, the East India Company, the Hudson Bay Company, the South Sea Company. These are all corporations that have been given kind of effectively political mandates to go and do colonizing, trading kind of things. And it borrowed large sums of money from them, and then the corporations raised this money from shareholders, who were the merchants, who had the money sitting around because they couldn't go to war. And some of the merchants started buying and selling in the stock of these corporations, thus making the government debt tradable and liquid. And they became, because they were jobbers previously, they became stock jobbers. And that title, stock jobber, persisted in London right until 1986, when it was abolished by Margaret Thatcher in the Big Bang. So London has this very, very long history of dealing in equity effectively, and with ups and downs and so forth. We have after the 17th century, you have a period of sort of furlough for a bit, and then we have the canal and the railway boom, and we have regional stock exchanges all over the UK funding this new infrastructure, and then that dies back a bit, and then we have in the 20th century 2 wars, and a period then of very much a kind of quite planned economy, but definitely kind of a socialist economy that was paying high returns on government debt and so forth. That wasn't a happy time for stock markets generally, or financial institutions, and then the great reforms of the 1980s. So they have a kind of parallel history, these markets, and there is an exchange of ideas and technologies and so forth between them. Chicago borrowed its rulebook from the Liverpool Cotton Brokers Association, which had formed a little time before the Board of Trade. But they're also histories that are linked with the nations that host them, more so, I would say. And so the history of Chicago is one of kind of speculation and the legitimization of regulatory ruling. In 1905 by Chief Justice, I forget momentarily, who rules that speculation is kind of a positive thing, and is the adjustment of society by competent men to risk, and at the same time puts the bucket shops out of business. And in the UK we don't see that. We see a different kind of trajectory, because we have a different historical background and a different kind of institution.
And of course, I mean, that's happened even relatively recently, because in the mid-1980s, the late 1980s, the launch of the Deutsche Terminbörse, now Eurex, now part of Deutsche Börse Group, which has become European Financial Futures Exchange, that was actually permanently being delayed, and was delayed by several years in its launch, because they could not get past a Weimar era law, which had been drawn up against hyperinflation, which effectively did not allow anybody to enforce a debt that had arisen from gambling. And actually, I mean, there are a series of issues that to this day, I mean, the Deutsche Börse Eurex, they still don't actually charge you a trading fee for trading on the exchange. They charge you a clearing fee for using the clearinghouse, so that it's all one big embroiled fee. So all of these sorts of legal eccentricities have been something before. Very interesting, the point you make about King William. But obviously you touch upon, and I'm going to jump forward in the narrative now, Mrs. Thatcher. And I mean, you have a chapter, it's actually entitled magnificently, God Bless Margaret Thatcher. What a marvelous title altogether. But certainly it was she who revolutionized the stock exchange and the financial markets in London during her era, like really, truly no other prime minister before or since, I think, possibly dating back all the way to William III.
And that quote, that chapter title is a direct quotation from one of my interviewees, who kind of had, we were chatting back over these career histories, and he just sort of sighed and said, "Oh, God bless Maggie, what wonderful things." But what was really interesting, Patrick, is talking to these guys, nearly all men, inevitably. In the 70s, they were really broke. It was really hard time. People talked about making their 2 and 6, which was the cost of the train fare into work and back again. They all had side hustles. There's a guy called Brian Winterflood, who was very, very eminent member of the sort of small company stock market community, now in his mid-80s. He and his wife ran a second-hand goods antique bric-a-brac shop in a little bit of East London, I think. And he remembers meeting another one of these are members of the stock exchange, and he meets his colleague selling carpet squares, not even whole carpets, carpet squares. They were broke. And then things got a little bit better in the early 80s. And one interviewee, John Jenkins, who subsequently started OFX, he remembered he could make £1,000 a day, £1,000 a day. He said, if he did this particular kind of trading, in the early 80s that was big money, but it was real hassle. People didn't want to do it. But you could do it. It was great. And then in 1984. John's firm made £1 million in 5 minutes of trading.
Yeah.
I mean, the scale of the transformation is absolutely astonishing. And what they made the £1 million on was the British gas offer. I'm thinking British Telecom offer was the first of the offer.
Yes, big privatization.
Big privatizations. And all of a sudden we had this new kind of this new investor. We had these adverts that were in the papers, on the telly. I don't know if you remember them.
I do.
If you see Sid, tell him.
Tell him. Yep.
And there's this lovely one where it's in this little country village in England somewhere, very thatched roofs and typical, and the poster's on his bicycle, and somebody goes into the pub, and they've all got these kind of different regional accents. And if you see Sid, tell him. Sid's this kind of everyman character cooked up by the advertisers. So you can have a bit of this now. You can buy your property, the national housing stock's being sold off, and you can buy a few shares in the telecoms or the gas, and you can make a bit of money on the stock exchange. People piled in, and of course for the people who were already there, the incumbents, it was manna from heaven. They made so much money. And then the next thing that happened was the rule that preventing foreign ownership was abandoned. So all of a sudden, these big global banks that had wanted a piece of the London Stock Exchange could buy one of the member firms, and they did. They bought the partners out, but that then meant the end of the partnership culture, and it meant a move to a kind of risk and bonus type culture and all of these kind of things. And of course we had a roaring bull market, but it came to a sticky end in 1989. But, and here's the but.
Yes.
Did Thatcher do all that, or did she do some of it? And was she sort of caught on the wave of history, as it were? And this is where it's interesting. So, one of the things that she did do when she first arrived is the government abandoned currency restrictions. There used to be quite deep restrictions on the movement of currency, and I think they really had to do that because the old gold standard order had fallen apart, all of these kind of things. So suddenly there was international currency flows in and out of London, and that effectively made the old kind of system for the stock exchange had survived by untenable. So then they had to reform the stock exchange. And meanwhile, the engineers, the technologists who've slowly been laying cables around the exchange and putting in data infrastructures and starting to help settlement, because nobody likes doing settlement because it's boring and all of these kind of things. But at the same time, are fed up. The engineers are fed up with being treated as second-class citizens, as staff by the members of the exchange. They've kind of engineered this coup from the inside, where they've established a new way of doing things. And suddenly you've got computers and screens and all the rest of it, and you have to re-regulate accordingly. So I think she was a gatekeeper for a sort of massive tidal wave of history that just swept through the markets in the late 1970s and through to the mid 1980s.
Well, I think you're absolutely right. I mean, there was a huge amount of probably pent-up demand in there because obviously the 1970s had been such a fiasco around the world with inflation, stagflation, you name it. There'd also been the fact that the 1st of May, was it 1974, had seen the deregulation of stock markets in the USA. And of course, President Nixon had also taken the dollar off the gold standard and therefore blown up effectively Bretton Woods, which leads us, of course, to the comment I always make, which is that in market structure terms, Richard Milhous Nixon is the greatest single president in the history of the United States of America. His broader political legacy may be open to debate to this day and going forward, but that's not our concern in that respect, because certainly what he did, he unleashed a tidal wave. And actually, you remind me when you're talking about some of the anecdotes, I mean, talking about the likes of Brian Winterflood and so on, Kenny Policari is one of our very earliest guests. Good grief, it must be the better part of 100 shows ago, ladies and gentlemen. He talks about a lot of this in New York in the early 1980s when he was ringing people up, couldn't get them to buy shares because they could get 12% on their money in the bank. So why were they going to bother buying shares when they were only going to get a dividend of something like 5 or 6%? Good grief, the idea of a share with 5 or 6% today is enough to make you go weak at the knees, isn't it? The whole system exploded. And I think that's a very, very interesting point. You talk about the British gas privatization. I think it is fair to say Mrs. Thatcher never really saw the idea of privatization as being this huge thing for share-owning Democrats in the early days. It was just when she went and privatized Brit Oil, because she was trying to shrink the size of the state, suddenly they realized, oh, there's something we can do with that politically. And that obviously became a huge success through British Telecom, British Gas, and so on to shrink the British state, which unfortunately subsequently every other government seems to have been trying to undo with alacrity, but none more so than the government of Scotland, who seemed to be able to grow the state faster than anybody this side of somebody whose name included Soviet in the title of the country. Gosh, is that hate speech? I don't know. At least I'm outside Scotland, so therefore I hope you don't get prosecuted by being in this conversation in St Andrews, the august seat of learning in the great nation of Scotland, and my grandmother's a Stuart. So anyway, Philip, really interesting. I mean, actually, at this stage, I'm going to introduce a question from Peter Second. He's been waiting patiently there on the sofa with Ari this evening. In your opinion, what are the current key significant challenges facing stock exchanges?
That's it. I've been looking at that question in the sidebar for a couple of minutes and wondering. I mean, it seems to me that the problems that are facing stock exchanges are not so much kind of technical or regulatory problems, although maybe that doesn't apply to some of the kind of new technology things that we're seeing, crypto and so forth, as Patrick just mentioned. But, you know, funnily enough, I think it's the tail, actually, in the UK anyway, it seems to me that it's the tail of exactly what we've just been talking about, the privatizations of 30 years ago and so forth. I mean, you know, we don't in the UK, we don't have effective functioning, you know, water companies anymore. It seems to be water seems to be the current issue. We've had disastrous problems with energy bills over the last few months and so forth. And I think this is a problem of not just the shift of ownership of these assets into private hands, but a particular kind of mindset discourse around the stock exchanges that really emphasizes, you know, quarterly earnings, statements, cost cutting, you know, return on assets, all of these kind of metrics that executives are beholden to by shareholders. And I think there's a really, you know, difficult sort of structural conundrum that exchanges have to face. And if they don't, if they just throw their hands up and say, well, we're just data providers, you know, we're just hosts of a trading facility, I can't see that they will be, you know, successful over the next three decades. I think it's a problem analogous to, you know, one that big tech faces is big tech's got to do something beyond go, well, we just, you know, kind of information infrastructure. Do these platforms, are they employers? You know, these kind of questions that the norms of doing business that circulate around and through stock markets are problematic to me at the moment. And in a way, that's another little sort of trick that I play through the book, is that I talk about stock exchanges, but I also talk about finance, and the stock exchange is kind of synecdoche for the whole of finance, because I think that, you know, the problems that we have in terms of distribution, in terms of kind of environmental degradation, all these kind of things, are problems that are to some extent operationalized through the mechanism of the stock market in the way that I've just described. So perhaps that's not quite the answer that you were hoping for, because I don't think it's a immediate technical or regulatory problem. I think the problem is that if we don't sort out a different kind of relationship with large quoted corporations, then the future might look increasingly difficult for financial markets and the sector generally.
Well, I mean, that's really interesting as an answer, actually, and let me therefore take up the cudgels on behalf of Peter to move this around. It's not because I disagree with you particularly. I mean, I think if you look at the UK privatization experience, there's no doubt that if you can actually acutely remember what it was like to deal with the British telecom monolith in the 1970s, which was entirely Soviet, that was a disaster. And I think certainly what the introduction of competition, if you remember Mercury being brought into the fray as the big competitors to BT, et cetera, and that drove BT to be much more of an efficient organization. And that certainly drove something that I think created a much better marketplace. And certainly to this day, I mean, we can all argue, of course, there are a lot of globalizing factors in there, the interweb through which we're speaking today, et cetera, but nonetheless, that certainly drove down prices and competition. And I think you hit the nail on the head. I mean, water is a complete fiasco because the water companies of the United Kingdom are totally and utterly useless. But at the same time, it's because they're all monopoly providers in their own little fiefdoms. And I mean, the railway companies are monopoly providers in their own little fiefdoms, unless for some reason you believe that there's competition in deciding that you want to take a train from St Andrews to London, and at the same time believing you can also achieve that by using, I don't know, the West Coast mainland and getting the train from Bristol to London, which does not seem to me to be remotely fungible. So you hit the nail on the head. I mean, there's a big problem of competition there, which has been a post-privatization headache, which actually government competition authorities, and indeed, I think it's fair to say, the stock exchange apparatus have not addressed. Go ahead, sorry.
I take the point that you know the monoliths of the 1970s were problematic, and I think, you know, we went through a period where things worked, and I wonder if we're just coming to the end of that period. But I don't think it's entirely about competition, because competition is only consumer facing, and what we're realizing now is that, you know, that there are these other obligations that firms might have. I mean, you know, I'm not in any way being nostalgic about the company town and all of these kind of things. This sort of very paternalistic attitude to employers or employees and that kind of thing. And I'm sure that chief executives of big conglomerates featherbedded themselves as much as they could. I mean, we've all read Barbarians at the Gates, and, you know the anecdotes of the flying the Alsatian away because he bit the security guard, flying him away in the corporate jet and that kind of thing. But, you know, the pressures that are imposed by stockholders on firms lead then to the outsourcing of other kind of costs, like labor costs, or maybe environmental costs, or all of these kind of things. And I suspect that, you know, to start with, those pressures helped a lot because they sorted out inefficiencies, they made things work better, they encouraged firms to pursue technical solutions and so forth. But after a while, you know, there's nowhere to go apart from squeezing employees, making work precarious, or all of these kind of things. I mean, it's a political choice, this, in the end, isn't it? You decide which side do you stand on. Are you you know, are you a stockholder or a worker or a manager or somewhere in between? But I think, you know, there's more to this than just competition. That's the point that I would make.
Yes, no, I don't think that's unreasonable. I mean, it just in the time we had, competition was one good way to start addressing the issue because,
Yeah.
and I think we're in totally heated agreement. I mean, the state of the 1970s was a disaster. What happened after Thatcherism induced a momentum for whatever reason towards efficiency, certainly did deliver a golden era. It strikes me that the one thing which has been appalling, particularly in the case of like the water companies, I mean, the water companies infuriate me because it never seems to do anything but rain in the United Kingdom. And yet the water companies seem to have a fundamental difficulty in managing to shore up their supply of this plentiful thing, which is quite incredible. I mean, I can understand there are problems for water companies in the Sahara or in the Caribbean where you only get particularly limited water supplies. But the idea that the UK can have water supply problem, that actually seems to be skewed around, I mean, shareholder return idiocy meets a refusal to invest. And there's definitely something that needs to be done there in order to manage to cure that. I think it's also interesting, I mean, you didn't hit upon it, but one area which I think is intriguing is the fact that exchanges, stock exchanges, are essentially reliant on a network of salespeople to sell their product who they don't employ. I mean, they're not even freelance. They're not even giving them a commission. Now, obviously, there are certain issues then if you give them a commission because the financial regulators dislike that in other ways. But nonetheless, it is quite strange that effectively, and I mean no disrespect, but as you mentioned his name, the good offices of Mr. Winterblood or one of these people, you know, Winterflood or one of these people, they're the sort of places that are actually out there as investment banks, nomads, whatever, selling the idea of listing on the stock exchange, where the actual stock exchange itself is relatively speaking a passenger in that sales process, which I think is a quirk that actually, curiously enough, a lot of exchanges have been reluctant to address over the years.
That's very interesting. Because effectively the exchange depends on a community of practice. So we often have this conversation. People ask, well, you know, how do I start a stock exchange? Or you talk to people who try to set up a niche exchange for trading wood pulp or whatever it may be, and often what people tend to do is they do the better mousetrap. You know, they rush off and they get the infrastructure and they go, well, you know, we can take time off commissions, or we get time off trading, or we can make commissions cheaper, or what have you. But it never seems to work. And I think you've hit the nail on the head, because what seems to work, why the two exchanges that I wrote up were successful, is because they existed in these kind of communities of financial practice. Exactly. Yeah. Very, very nice. Absolutely. And they absolutely depend on that, and that's what brings the business in, and it's kind of a mutually self-reinforcing circuit, because the advisors can trade fees and so forth. But the exchanges don't acknowledge it. And that is also potentially a really significant problem for them, because, you know, if the community of practice dries up for whatever reason, then they don't have a business anymore. And I think that funnily enough is where when OFX became Plus, and it tried to change its business model, and it tried to take on AIM and all of these kind of things, and I think it never got that kind of, you know, support from its core group in the same way, because it positioned itself as a superior trading venue, which technically it might have been, but, you know, it never flew.
Absolutely, and it's quite a fascinating thing. I agree with you completely, because the community of practice, what a useful buzzword for the day that is, but you're quite correct. And of course, this is one of the reasons why, going back to the original debate, and actually this is a debate we're going to be having in a few weeks' time, ladies and gentlemen, when Gideon Hurston is going to be a guest on this show, is the whole issue of mutualized exchanges going for profit, and how that's been good in many respects, but in one way it has not been so good, because you've ended up with the internal members, that community, have no longer had such a direct ability to influence the management of the exchange. But of course, on the other hand, it has also had negative impacts on exchanges, because you end up with things like, well, I mean, the voting structure for the board of directors of the Chicago Mercantile Exchange Group to this day still effectively works on the same concept of authorized candidates as was beloved of the Communist Party of the USSR and other communist non-democracies. So it's very difficult to unpack all of this in sort of 1 hour. And I'm mindful of the fact we've got about 15 minutes to go here, Philip. And as you say, it's very difficult to build these new markets. It is easy to go down the better mousetrap route. One of the things we have seen, obviously, recently has been this growth in things like cryptocurrency and all these sorts of things. Do you get to that in the book, or indeed, do you have any views on that yourself?
In the book, I mean, it's a fascinating phenomenon, one that I don't fully understand. Clearly, these things also grew out of communities of practice. This is one of the ironies about them, is that they claim not to. They claim to be this kind of trust-free, decentralized, everything's in the open ledger kind of affair. But in fact, they're entirely sustained by networks of exchange on, initially between computer geeks and more recently on Reddit and other such places. And I mean, it pains me a little bit, because I think we've seen a real speculative bubble, of course, but it seemed to me that there was a particular slant that there were youngsters getting caught up in it who, for reasons that we've just previously talked about, who perhaps don't have the career opportunities that we might have had when we were young, or what have you, are inclined to embrace the possibility of risking everything and getting very wealthy. And some of them did, of course, but a lot of youngsters didn't. I think a lot of people lost a lot of money. We seem to lack the kind of, you mentioned finance earlier on, and the kind of things that we take for granted in dealing with regulated national stock exchanges, that you'll actually be able to get your money out if you want to, and that kind of thing, supposing that you haven't lost it all. We can't necessarily take them for granted. So I find it very, very perplexing and a little bit disquieting. And of course, we all know the environmental impact of proof of work type crypto is absolutely devastating. I mean, you read a newspaper headline that says that the electricity regulators in Texas have asked the crypto miners to turn themselves down because the weather's too hot and the infrastructure can't support the air conditioning in people's houses and the mining of the crypto. You think that there's something not right here, and I can't see the case for social benefit that you made so eloquently, say, for Thatcher's reforms. I mean, there's a clear argument to be made. I'm just absolutely not persuaded by any of that. So, I mean, we meet people all the time who are convinced of the future benefits and this kind of wide open democratic future and what have you. But I'm afraid I'm a skeptical old man when it comes to this. It may be because I just don't properly understand it, but I think there are significant issues that circle around it as well.
And I think to that end, actually, you've elegantly answered or addressed most, if not all, of this question from Peter Secon. What are the biggest regulatory, compliance and technology infrastructure changes on the back of crypto winter? I'm not sure if you want to add anything. I think you probably answered it, actually, without my asking the question.
Well, I mean, how can we have... Regulators are always chasing. It's an unfortunate role of being a regulator, is that when you've regulated something, the clever guys in Wall Street have thought up something else and all the rest of it. But if you have something that we really don't understand, we don't know where it is, we don't know what it's doing. We've got this huge market that is sort of technologically opaque as well. It's a very, very difficult challenge for a regulator. And how do you bring that into being something that is kind of well, safe is too strong. I'd be quite in favour of a caveat emptor market. But the thing about a caveat emptor market is you have to be able to see and understand what you're buying, or at least if you're a skilled market participant, you should be able to see and understand what you're buying. And I just really don't. And I think the things that we see trickling out, so catastrophic failure before Christmas, the name of which FTX, of course, and the ongoing struggles with the other exchanges and so forth. I mean, my experience of actually buying crypto, I thought, really just before the peak of the bubble, I think just about when Mr. Musk was on Saturday Night Live, I thought, I'm gonna, buy some of the really silly stuff, and I bought a little bit of Doge, and I thought I'd blow myself up and write something about it, and I put in Hunter S. Thompson style, and of course I blew myself up, but I never wrote anything about it. It wasn't that interesting in the end. I just put some money into something that I didn't know anything about, and then it wasn't there anymore. And what's interesting about that?
Which leads us all to the classic Woody Allen definition of a stockbroker: someone who invests your money until it's all gone, which was a delightful description by a man whose parents were, of course, children of the Great Depression. Thank you, Peter Second, for those questions. They're really, really terrific. So look, I mean, your book, How to Build a Stock Exchange, it's available now in all good bookshops. It's talking about the past and present and all sorts of issues relating to markets and the future of finance. It's a really, really good read. I thoroughly enjoy it. It is, as you say, everything except actually how to build, but it does explain. But I think what it does do, which is really, really good, and this is as somebody who does build these markets day in, day out, is it explains the complexity. Because the absolute overarching frustration that I have is people who say, oh, I've got a bit of technology, I've got a website, a Rolodex of 5 people who bought this in the last month, year, whatever, and I know how that works. So therefore, I should have an exchange. And armed with a rule book that's probably not remotely suited for what it is they actually want to do, they seem to sally forth, which is a bit like saying, I've got the recipe from, I don't know, a Prue-Leith cookbook and a menu from McDonald's and an old cooker and microwave that I bought off, I don't know, some Sea Link ferry from the 1980s, and I've installed that all into a restaurant in Croydon. I should be great as a restaurateur. And strangely enough, what is it? I mean, roughly 90% of all restaurants fail, I think, within the course of 2 to 3 years. Anyway, that was enough of my rant on that topic. Philip, tell us anything else you'd like to tell us about your book, or you'd like to highlight in it before we get to the final question.
Anything? I've told you a lot about the book, Patrick. Actually, I think I keep dragging it back into the conversation despite your best efforts. I mean, it's a fun read, as you're kind enough to say. It's not a scholarly book, even though I'm an academic. It is accessible, and there's some interesting stories. And there's a young and well-fed and rather naive, well-fed because we were constantly wined and dined by the PR firms, and rather naive journalist who gets himself into near scrapes on a couple of occasions. But no, I think we've talked about it lots.
Very much the likes, ladies and gentlemen. We really appreciate them on this show because it helps the artificial intelligence of the algorithms get us up the rankings, which therefore allows people like Philip to be watched more often and indeed sell more books. And the important thing about selling Philip's book is the fact that it gets more people interested in stock exchanges. And if we do that, we get more investors. If we get more investors, we get more wealth to spread around the world, notwithstanding the fact that hashtag it's complicated when you go out there to build a marketplace and expand it. So Philip, that leaves us very elegantly with 5 minutes to go at the last question of the day. And therefore, where do you believe the capital market revolution goes next?
More people coming into stock markets, more markets means more money to invest and so forth. And you know, I'd like to think that it does. And that really is the key for me is clearly we face some really quite significant challenges. We being people, the globe, the environment, all of these kind of things going forward. I've alluded to some of them: the environmental degradation, inequality, precarity, all of these kind of things. And I think that stock markets are going to be a crucial, in all shapes and forms, are going to be a crucial part of enabling us to tackle these, because they're going to need money. And the one thing that the historical trajectory of markets shows is that they're good at funding stuff. And they funded railways, they funded canals, they funded .coms and so forth. And in each of these cases, of course, we've had a speculative boom. People do like a boom, and there's a bit of a bust. But the infrastructure that is paid for hangs on. We live in a market world now that's created by .com and the investments that went in then. We enjoyed the Industrial Revolution, was powered by trains and canal boats and those kind of things. But the problem is that over the last three decades or so, I would say, stock markets have been about taking money out. They've been about paying off shareholders, paying dividends, squeezing workers, whatever. As I say, they are the political fulcrum on which this kind of balance hinges. And I'd really like to see markets funding stuff, doing what they claim to do. They have this kind of historiography of being a crucial part of the genesis of industry and so forth, and that's not necessarily true, and I don't think it's been true the last couple of decades. I really think it should be. And I think related to that, I'm not sure that we necessarily have to have everything drifting towards big, supranational global exchanges. They obviously have a place, but I think we could imagine smaller, fit for purpose kind of bespoke markets that tackled specific kind of technical or social problems, and did so in a way that was efficient and financially fluent and so forth. And we can kind of imagine all sorts of situations where that might take place. And each of those would need not a better mousetrap, but a community of practice and support and financial backing and so forth. So I think, for example, we could have a national exchange in Scotland. We haven't had one since 1973, so 50 odd years since the Scottish one was closed. I think there are good reasons that are not necessarily nationalist for keeping capital close rather than sending all the way down the road to London, where it goes off globally and does other things. And Scotland has a green agenda and all of these kind of plans. Then we could help fund that, and we could help build that. So that's what I'd like to see. I'd like to see stock markets, paying for things and making things.
Stock markets paying for things and making things sounds absolutely marvellous to me altogether. I think a stock exchange in Scotland is also essential. Regardless of where one might sit on the debate over Scottish independence, I think whether Scotland has a glorious future, which I hope it has within the United Kingdom, it would still be magnificent to see a Scottish stock exchange being re-established, and vital for enterprise in the country and in the regions of the UK. I've long been an advocate of that. On that note, thank you very, very much, Philip Roscoe. As Robert Brown says, thank you so much, Robert, for your input and for your loyal viewership. More, please. Thank you. Good stuff here. Totally agree. This has been How to Build a Stock Exchange with Philip Roscoe, a reader at the St Andrews University, one of the most historic universities in the world. Thank you also, Matt Timms, for your greetings earlier on, Peter Secon for your questions, and all of you for watching today. We're going to be moving to Chicago for our next show. Actually, we're going to be talking about from the Chicago Mercantile Exchange. That's just around the corner in the loop from the Chicago Board of Trade, about which we were speaking earlier. We're going to be talking to a very, very famous former director of the exchange and floor trader there, Jeffrey Carter, discussing how he went from the Merc floor to angel funding. Ladies and gentlemen, that's been your show this evening. Thank you very, very much. Show us a like. We'll see you next Tuesday. To Philip Roscoe, to our production team of Herminia, Marianne, and Racy, this has been a marvellous show. My name is Patrick L. Young, building markets the world over. I wish you a great week in life and markets.